Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over Roth IRAs and 401ks. And we're going to be doing that the superfast CPA way, which is diving straight into questions to learn the material. Now, if you don't know much about our strategies, make sure to go check out our free 1-hour webinar training on SuperfastCPA.com. We go over the key ingredients to passing the CPA exam, and again, it's free, it's only 1 hour long, and we will save you so much time struggling with your process. Also, just letting you know, we will only be going over 5 questions in this video, but Superfast CPA members will have access to the full 10-question video when we post it on the members forum. So if you like this, you can get more of it and more practice by becoming a Superfast CPA member. One more thing, this is a continuation of our short group of videos about retirement accounts. So if you haven't seen the previous video about traditional IRAs, make sure you go watch that. And keep in mind that for this video and the other retirement account videos, we're trying to show how different they are so that you can figure out the advantages and disadvantages. Let's go ahead and go to the first question. Okay, here is question 1. Which of the following statements about Roth IRAs is not correct? Select the incorrect option. Okay, so if you don't know anything about Roth IRAs, then this might be difficult, but if you have a general idea, go ahead, pause the video, think through these responses, and when you're ready, come back, we'll look at the answer. But if not, let's go ahead and look at the answer to start learning about Roth IRAs. Okay, the answer is D. Roth IRA contributions are limited by your annual income, but there are no income limits that completely disqualify individuals from contributing. So that's incorrect. Let's read about it. Roth IRAs do have income limits that can disqualify individuals from contributing if their income exceeds certain thresholds. While people with higher incomes may still be able to use a backdoor Roth IRA strategy, direct contributions are not permitted above these limits. Contributions to Roth IRAs are made with after-tax dollars, meaning they're not tax-deductible at the time of contribution, which differentiates them from traditional IRAs. One of the major benefits of Roth IRAs is that both contributions and earnings can be withdrawn tax-free after the age of 59.5 as long as the account has been open for at least 5 years. Additionally, Roth IRAs do not require minimum distributions during the owner's lifetime, allowing the funds to continue growing tax-free, which can be advantageous for long-term retirement planning and estate management. So right there, especially if you've watched the previous video about traditional IRAs, there are some big differences between Roth IRAs and traditional IRAs, mainly that you put in after-tax dollars instead of pre-tax dollars, and when you take them out, they're tax-free, and there's no required minimum distributions. So Roth IRAs are pretty awesome. With that, let's go ahead and go to the next question. Okay, here is question 2. Consider a married couple filing jointly with a modified adjusted gross income of $220,000. For the current tax year, the phase-out range for Roth IRA contributions for married couples filing jointly starts at $204,000 and ends at $214,000. So we have to calculate how much, if any, this couple can contribute to a Roth IRA. So, assuming the maximum allowable contribution is $6,000 a person, choose the correct answer from the following options. Now, obviously, I think this is pretty clear. They're not going to be able to contribute at all because $220,000 is obviously above this range of $214,000. So, without even thinking too much, we can probably assume it's $0. But the idea behind this question is to kind of show you how you would do that calculation so that if they were in this range, then you would still know how to do the calculation. So let's go ahead and go to the answer to start learning about that. So again, $0. Let's look at the calculation. So first we have to learn how to calculate the reduction using the formula provided. So to calculate the reduced contribution, we take the max contribution, and this is per person, and that's $6,000. And then you subtract all of this. And the calculation is modified adjusted gross income less the phase-out start, all divided by the phase-out range, and then you multiply that number by the max contribution and subtract it all from the max contribution. So let's look at it with the actual numbers. So the reduction is, and this is this part of the equation. We're not looking at the max contribution right now. We're just looking at this part. So $220,000 less $204,000, and that's $16,000, divided by $214,000 less $204,000, and that's $10,000. So $16,000 divided by $10,000 multiplied by $6,000, and that gives you $9,600. And you're like, okay, but then you subtract that from the actual max contribution, which is $6,000, and that puts you negative $3,600 or zero because you can't go negative. So they're so far over it that their reduction is actually negative, or basically they just aren't allowed to contribute to a Roth IRA. But I hope you can see from this that if somebody was in the phase-out range, like within it, then this would give you some kind of reduction that would reduce the $6,000, and then that would be how much each person could contribute to the Roth IRA. And the whole point of this is to show that high earners are phased out of eligibility to contribute to Roth IRAs. So this is one disadvantage of Roth IRAs compared to traditional IRAs. Let's go ahead and go to the next question. Okay, here's question 3. James, age 55, earns $150,000 annually and participates in his employer's 401k plan. His employer offers a match of 50% of his contributions up to a maximum of 6% of his salary. Given the IRS limits of $22,500 and including his $7,500 catch-up contribution and aiming to maximize his retirement savings, James is considering how to best allocate his contributions for the year. Considering tax implications and future retirement needs, which of the following strategies should James consider? Okay, so this is the first question about 401ks instead of Roth IRAs. There's a lot of information in this, and if you don't know much about 401ks, that's okay. If you want, go ahead, pause the video, try to think through this and see if you can get the correct answer. And if not, let's go ahead and go straight to the answer to learn how this works. So it seems like the best answer is that he should contribute exactly enough to get the maximum employer match and then invest any additional savings into a Roth IRA or another investment vehicle. So let's learn about this strategy. This strategy maximizes the employer's contribution match, which is essentially free money, and takes full advantage of his tax-deferred contribution limit. By contributing $18,000 to maximize the $9,000 employer match, James ensures he is making the most of the employer benefit. Any additional funds he has available for retirement saving can then be allocated to a Roth IRA, where earnings can grow tax-free, providing a balanced approach to his retirement savings, taking advantage of both tax-deferred and tax-free growth opportunities. So let's kind of break this down a little bit. First off, it says that his annual income is $150,000, and he has a 401k plan with his employer. His employer matches 50% of his contributions all the way up until 6% of his salary. So 6% of his salary is this $9,000 here. They will continue matching 50% of his contributions all the way up until they've met $9,000, which is their maximum that they're willing to do. So if he contributes $18,000, that means that they will have contributed the full $9,000 that they're willing to do. So that means that he's contributed only $18,000, but he ends up with $27,000 in his 401k, which is basically $9,000 of free money. So he can take that money that he would have used in his 401k and put it in a Roth IRA, which will give him some tax-free growth as well as tax-deferred growth. Now, obviously, you could argue maybe it would be better for him to contribute all the way to the $30,000, which is the maximum amount he can do. But this question is mainly there to show you a few different things. First off, that there is an IRS limit to how much somebody can contribute to their 401k. But once they're past a certain age, they can start making extra contributions to catch up. And then finally, that a lot of times employers will match some of the contributions that the employee makes to their 401k, which is a big advantage of 401ks. And also, if you'll notice, these contribution limits are much higher than traditional IRAs and Roth IRAs. So that was kind of the idea behind this question, to kind of show all these different things about 401ks and also show that it's wise to distribute between different retirement options. Let's go ahead and go to the next question. Okay, here is question 4. Which of the following statements accurately describes a key difference between Roth IRAs and 401k plans? Okay, we've talked a little bit about this. So if you think you can figure out the answer, go ahead and pause the video and pick the correct one. But if not, let's go ahead and look at the answer to see what some of the differences are between Roth IRAs and 401ks. Okay, and the answer is that 401k plans are typically offered by employers and may include matching contributions, whereas Roth IRAs must be opened by individuals without any contribution matching. So let's kind of read through this. So A is incorrect because Roth IRA contributions are made with after-tax dollars, which makes this obviously not true. And then for 401k contributions, some of them can be made with pre-tax dollars, which is a traditional 401k, and that's the one that you're going to see pretty much all the time. Or there's after-tax dollars for a Roth 401k, again, something you're not really probably going to deal with for the CPA exam. Option B is incorrect as it reverses the requirements. Roth IRAs do not have required minimum distributions during the owner's lifetime, whereas 401k plans, like traditional IRAs, do generally have RMDs when the account holder reaches 72 years old. And then question D is a little bit confusing. It's partially correct because It says here 401k plans are typically offered by employers and may include matching contributions, whereas Roth IRAs must be opened by individuals without any contribution matching. So that's mostly correct for Roth IRAs, but it's incomplete and misleading for 401ks because it ignores the existence of Roth 401k plans, which also offer tax-free withdrawals. Now, again, that's a little bit tricky because Roth 401ks, not something you're probably going to encounter too much in the CPA exam. So you mainly need to focus on traditional 401ks. And so the main thing you need to focus on is that 401ks typically are from employers and Roth IRAs are typically individual. Let's go to the next question. Okay, here is question 5. Jean, aged 45, makes an early withdrawal of $10,000 from her 401k to cover an emergency expense. This withdrawal does not qualify for any of the exceptions to the early withdrawal penalty. Calculate the early withdrawal penalty Jean will face for this withdrawal. Okay, so if you've watched the previous video, you know that early withdrawal penalties for traditional IRAs are 10%, but is it the same for 401ks? We're not totally sure. Go ahead and pause the video and see if you can think through it, but if not, let's go ahead and look at the answer. Okay, the answer is that there would be a $1,000 penalty, and it looks like it's similar to the traditional IRA withdrawal penalties. The IRS imposes a 10% early withdrawal penalty on the taxable amount withdrawn early from retirement accounts when no exceptions apply. So, looks like it's just in general for retirement accounts that have this withdrawal penalty. Since Jean withdrew $10,000 from her 401k and no exceptions to the penalty rule apply, the penalty is calculated as 10% of $10,000, which is $1,000. Okay, pretty simple. This video had a big mix of a whole bunch of different things for Roth IRAs and 401ks because they're covered a little bit less in the CPA exam. So I was trying to show you a whole bunch of different things about them just to help you be prepared. Before we go any further, let's go ahead and do one more part of the strategy called pillar topics. Now, the idea behind pillar topics is as you're going through the material, you will notice calculations, concepts, equations that keep coming up that are obviously important because you've seen them through 4 or 5 questions. So you know that they are important and you need to know them for the CPA exam. So you write them down as pillar topics so that you can know them for later. Let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics. First off, Roth IRA contributions are made with after-tax dollars only, whereas 401k plans can accept both pre-tax for traditional, and again, we're mainly focusing on traditional, and after-tax Roth 401k contributions. Withdrawals from Roth IRAs are tax-free if certain conditions are met, while withdrawals from traditional 401ks are taxed as ordinary income, kind of like a traditional IRA. 401k plans are employer-sponsored, often featuring employer contributions through matching, while Roth IRAs are individually set up without employer contributions. Roth IRAs do not require minimum distributions during the owner's lifetime, whereas 401k plans typically require minimum distributions starting at age 72, and again, that's similar to a traditional IRA. The contribution limits for 401k plans are generally higher than those for Roth IRAs, allowing for greater annual savings potential in a 401k. And just think about this, for 401ks, there was that contribution limit that we saw that was like $22,500, whereas for Roth IRAs, typically it's around $6,000 or $7,000, depending on the year, obviously. So a big difference there. Finally, Roth IRAs have income limits for eligibility to contribute, which can phase out contributions for higher income earners completely, but 401ks do not have income limits for contributing, making them accessible regardless of income level. Okay, so even if it was kind of hard to see some of those pillar topics throughout the questions, these are some very important things that you will need to know concerning Roth IRAs and 401ks for the CPA exam. So I hope that you learned a lot, and with that said, let's go ahead and finish up. Before you go, I just want to give you one more reminder about the SuperfastCPA training webinar on SuperfastCPA.com. It's only 1 hour long, and we go over the key ingredients to passing the CPA exam. Again, it's something that you don't want to miss. It will save you so much time with the process. Also, if you liked this, just remember that SuperfastCPA members have access to the full 10-question video when we post it on the members forum, so you can get more of this and more practice by becoming a SuperfastCPA member. If you liked this video, make sure to like it and leave a comment. Thank you for watching. I hope this was helpful, and I will see you in the next video.